It was 2:17 in the morning. The room was dark except for the glow of a laptop screen. Red candles kept printing one after another. Every tick down felt personal. Every small bounce looked like hope, then disappeared. He wasn't new to the market. He had seen pullbacks before. But this felt different. News headlines screamed fear. Social media was louder than ever. Group chats were filled with panic screenshots. Words like collapse, crash, and recession echoed everywhere. And there he was, cursor hovering over the sell button. You know that moment. The moment where your long-term plan suddenly feels stupid. Where patience feels like denial. Where holding feels irresponsible. His heart wasn't racing because of the numbers. It was racing because of doubt. What if this time is different? What if it doesn't recover? What if I lose everything? Drawdowns don't just test your portfolio. They test your identity. It's easy to believe in long-term investing when the chart moves up. It's easy to preach patience when your account is green. But when everything is red, when your profits from months, even years, slowly shrink, that's when the real test begins. Here's the strange part. The market crash wasn't the most dangerous thing in that room. His emotions were. Because in the middle of a storm, the instinct is to run. To react. To do something, anything, just to feel in control. But long-term thinking asks for something unnatural. It asks you to stay still. Imagine standing in the ocean during a massive wave. Your first instinct is to fight it, to thrash your arms, to resist the force. But the more you panic, the more energy you lose. Experienced surfers don't fight the wave blindly. They understand it. They position themselves. They move with structure, not fear. Markets are no different. Crashes feel like the end, but historically, they've been transitions. They shake out the impatient. They transfer wealth from the emotional to the disciplined. Long-term thinking works during drawdowns not because it ignores pain, but because it understands cycles. That night, he didn't press sell. Not because he wasn't afraid. But because he had something stronger than fear, perspective. He zoomed out. 5 years. 10 years. 20 years. The red looked smaller. The panic looked temporary. And for the first time that night, he realized something powerful. Stillness is a position. If you've ever felt frozen during a crash, if you've ever questioned your entire strategy when the market turns against you, stay till the end of this video. Because after watching this, you'll realize how to stand still in a market crash, without letting fear make the decision for you. 1. The moment fear feels rational. When the market crashes, fear doesn't knock politely. It kicks the door open. He didn't wake up planning to panic. He had a strategy. A time horizon. He told himself he was investing for the long term. But when the portfolio dropped 5%, then 12%, then 18%, something inside him shifted. The strange thing about drawdowns is that they don't just reduce numbers, they distort perception. Loss feels louder than gain ever did. Psychologists call it loss aversion. The pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. So when the account falls, the brain doesn't interpret it as temporary volatility. It interprets it as danger. And the brain is wired to eliminate danger, not optimize returns. His heart rate increased. His breathing changed. He checked the charts more often. Every red candle felt like confirmation that something was wrong, not just with the market, but with him. Maybe I misread everything. Maybe I'm not cut out for this. Maybe smart people already sold. Notice what happened. The crash outside triggered a crash inside. When prices fall, the primitive part of the brain, the amygdala, activates. It doesn't care about your 5-year plan. It cares about survival. It sends one clear signal: reduce risk immediately. Selling feels like relief. Not because it's strategic, but because it stops the bleeding. That's why panic selling can feel logical in the moment. It feels responsible. It feels proactive. It feels like control. But here's the psychological trap. Relief is not the same as wisdom. He almost sold not because the fundamentals changed overnight, but because his nervous system was overwhelmed. The volatility wasn't just on the screen, it was inside his body. And this is where long-term thinkers separate themselves. They understand that in a crash, your mind becomes your biggest variable. Markets move in cycles, but emotions move in spikes. Sharp. Sudden. Intense. The untrained investor tries to eliminate the discomfort. The disciplined one studies it. He noticed something subtle. Every time he zoomed into the 1-hour chart, fear increased. Every time he zoomed out to the 5-year chart, something shifted. The drop looked painful, but not unprecedented. Context shrinks panic. Education doesn't remove emotion. It regulates it. That was the first realization. The urge to act wasn't coming from analysis. It was coming from biology. And biology is reactive. Long-term thinking is intentional. In the middle of a crash, fear feels rational. But not everything that feels rational is aligned with your future. Before learning how to survive a drawdown, you first have to understand the battlefield isn't just the market. It's your mind. 2. When action becomes an escape. The hardest part wasn't the red candles. It was the silence between them. When the market crashes, there are moments where nothing happens. No bounce. No reversal. Just a slow bleed. And in that silence, the mind starts negotiating. Maybe I should reduce exposure. Maybe I should hedge. Maybe I should rotate to something safer. It sounds strategic. But sometimes, it's just discomfort looking for movement. He noticed something about himself. The more uncertain things became, the more he wanted to act. Not because he had new information, but because standing still felt unbearable. Doing nothing felt like weakness. Yet every time he clicked, adjusted, trimmed, re-entered, there was a brief wave of relief. A small sense of control. A feeling of, at least I did something. That relief was addictive. Here's what most people don't realize. Action reduces anxiety temporarily. It gives the brain a signal that the threat is being handled. But temporary relief can trick you into thinking the decision was correct. Relief doesn't equal alignment. It just means the tension dropped for a moment. And markets know how to exploit that tension. Volatility magnifies your internal noise. Every small bounce feels like confirmation you sold too early. Every drop after you hold feels like proof you should have exited. It becomes a cycle of second guessing. The real danger isn't the drawdown. It's overreacting to it. He began to see that his urge to constantly adjust wasn't coming from analysis, it was coming from impatience with uncertainty. He wanted the discomfort to end. He wanted clarity now. But long-term investing was never built for now. It was built for endurance. There's a quiet discipline in letting your plan breathe. In accepting that not every red week requires intervention. In understanding that reacting to every fluctuation slowly erodes the edge you worked so hard to build. He asked himself a different question. If I didn't look at this for 3 months, would my thesis change? That question slowed him down. Because sometimes, the need to act is just the need to escape the feeling of being powerless. And the market will always give you reasons to move. But growth in investing, real growth, often comes from resisting the urge to treat every wave like an emergency. In a crash, movement feels strong. But composure is stronger. 3. The pain of watching. He didn't sell. That was the surprising part. But not selling didn't mean he was calm. Every day became a test of endurance. He would open his laptop, sit in front of the screen, and just watch. The numbers moved. The account fluctuated. Sometimes it recovered a little, only to sink again by the afternoon. There's a specific kind of pain in watching something decline that you worked hard to build. It's not dramatic. It's not loud. It's slow. Drawdowns attack your sense of progress. And progress is deeply tied to identity. When we see growth, we feel competent. When we see regression, we question ourselves. He caught himself thinking, all those months, for this. That thought is dangerous. Because it reframes temporary volatility as wasted effort. The mind hates regression. Evolution trained us to seek improvement and avoid loss. So when your portfolio shrinks, your brain interprets it as moving backward in life, not just in markets. That's why crashes feel personal. But here's the shift that changed something inside him. He realized he wasn't just watching numbers fall. He was watching his tolerance expand. Every red day he endured without reacting was building something invisible: emotional capacity. We talk about capital as money. But there's another form of capital most traders ignore. Psychological capital. The ability to sit with discomfort. The ability to delay gratification. The ability to endure uncertainty without self-sabotage. Those don't show up on a chart. Yet they compound. At first, every 2% drop felt heavy. Then he noticed something subtle: the same movement didn't shake him as much anymore. Not because he didn't care, but because he had seen it before. Exposure reduces fear. The first time you experience volatility, it feels catastrophic. The fifth time, it feels cyclical. This is where long-term thinkers are shaped. Not during rallies, but during boredom, frustration, and doubt. He began to understand something powerful. Pain isn't always a signal to escape. Sometimes it's a signal that you're stretching beyond your previous limits. If you leave every time it hurts, you stay fragile. If you stay when it hurts, thoughtfully, intentionally, you become steady. Markets reward steadiness over brilliance. And steadiness is built in moments like this. He still felt the discomfort. He still questioned things late at night. But instead of asking, "How do I make this stop?" he started asking, "What is this teaching me?" That question changed the energy. Because watching the decline stopped being passive suffering. It became training. And in the middle of the crash, without realizing it, he was becoming harder to shake. 4. The voice that wants out. By the second week of the crash, the numbers weren't the loudest thing anymore. The voice in his head was. It didn't shout. It whispered. Just reduce a little. You can always buy back lower. Smart investors protect capital. It sounded reasonable. Calm. Logical. That's what made it dangerous. The mind is incredibly good at building arguments that protect us from discomfort. It doesn't present fear as fear. It presents it as strategy. He noticed how convincing the voice was during red days, and how quiet it became on green ones. That's when he realized something uncomfortable. The voice wasn't based on analysis. It was based on emotion trying to sound intelligent. There's a psychological bias called recency effect. We overweight what just happened and assume it will continue. After several red days, the brain starts predicting more red days. Not because it has superior forecasting ability, but because it mistakes repetition for certainty. So when the market kept falling, his brain adjusted its expectations downward. This is the new direction. This could last years. This time might be different. The fear wasn't about losing money anymore. It was about being wrong. Admitting he entered at the wrong time. Admitting he underestimated risk. Admitting he wasn't as prepared as he thought. And that's where ego quietly joins the conversation. Selling in panic doesn't just protect capital. Sometimes it protects pride. If he exited now, he could say, "I avoided further losses." If he held and it kept dropping, he'd have to face the discomfort of looking foolish, at least temporarily. But long-term thinking requires humility. It requires accepting that you will look wrong before you look right. He started journaling his thoughts instead of acting on them. Every urge to sell, he wrote down the reason. And when he read them back later, something stood out. Most of the reasons weren't about fundamentals. They were about feelings. I don't like this. This feels heavy. I'm tired of seeing red. Feelings are valid. But they're not always directives. He began separating signal from noise, not on the chart, but inside his own head. When a thought appeared, he asked, "Is this coming from my plan, or from my discomfort?" That question slowed him down. The voice that wanted out didn't disappear. It still showed up during volatile sessions. But it lost authority. Because once you recognize that fear can disguise itself as logic, you stop treating every internal argument as truth. Crashes don't just test conviction in the market. They test conviction in yourself. And sometimes the real breakthrough isn't silencing the voice that wants out. It's learning not to obey it automatically. 5. Zooming out when it feels impossible. One night, after another red close, he did something different. Instead of staring at the 1-hour chart, he dragged the screen back. 1 month. 6 months. 3 years. 10 years. The drop that felt massive suddenly looked smaller. Not insignificant. Not painless. But part of something bigger. That's the strange thing about perspective. It doesn't change reality, it changes scale. When you're inside volatility, every move feels amplified. A 3% drop feels catastrophic when you're zoomed in. But when you widen the lens, you start seeing structure instead of chaos. He realized he had been living inside micro-movements. Reacting to noise. Letting short-term fluctuation rewrite a long-term story. And psychologically, that makes sense. The brain is wired for immediacy. It prioritizes what's happening now over what might happen years from now. Immediate pain screams louder than future reward. That's why long-term thinking feels unnatural. It requires you to override your biological urgency. When he zoomed out, something shifted inside him. The chart wasn't just red candles anymore. It was cycles. Expansions. Corrections. Recoveries. Periods of boredom. Periods of fear. He saw previous crashes that once looked terrifying, now reduced to small dents in a rising structure. And a quiet question formed. If others endured those moments, why am I treating this one like the end? Drawdowns distort time. They make temporary pain feel permanent. But markets move in seasons. No winter announces the exact day spring returns, yet it always does. That perspective didn't eliminate uncertainty. It restored proportion. He began reframing the situation. Instead of asking, "How much am I down this week?" he asked, "Has the long-term thesis changed?" Not the price. The thesis. Because price is emotional. Thesis is intentional. If the foundation was intact, then volatility was just surface turbulence. Zooming out also did something else, it exposed impatience. He realized part of his frustration came from wanting results faster than reality allows. He wanted compounding without enduring contraction. But growth in markets, like growth in life, isn't linear. It's jagged. Uneven. Uncomfortable. When he stopped demanding smooth progress, the crash felt less like betrayal and more like process. Perspective doesn't remove risk. It removes exaggeration. And in the middle of a drawdown, exaggeration is what fuels panic. That night, he closed the lower time frames and left only the long-term chart open on his laptop screen. Not as denial, but as a reminder. He wasn't trading minutes. He was building years. 6. Choosing who you become in the crash. By now, the market hadn't fully recovered. It was still unstable. Headlines were still dramatic. Volatility still showed up without warning. But something had changed. Not outside. Inside. He noticed that the crash was no longer just an event happening to him. It was shaping him. Every decision, to hold, to pause, to think before reacting, was quietly building identity. And identity is powerful. Because once you see yourself as someone who panics, you'll panic again. But if you start seeing yourself as someone who stays composed under pressure, your behavior begins to align with that image. At first, he thought discipline was about rules. Entry rules. Exit rules. Risk management rules. But in the middle of the drawdown, he realized discipline was about self-concept. Who are you when things fall apart? Anyone can look confident in a bull market. Gains create certainty. But crashes strip away illusion. They expose emotional habits. They reveal how fragile or grounded you really are. And here's the uncomfortable truth he faced. Part of him was attached to being right. When the market was rising, being invested felt intelligent. During the crash, holding felt stubborn. The same action, different narrative. That's when he understood something deeper. The market doesn't just test your strategy. It tests your ego. Are you holding because your plan is intact? Or because you refuse to admit you misjudged something? Are you selling because risk changed? Or because your pride can't tolerate temporary pain? These questions are hard. They don't show up in technical analysis books. But they determine longevity. He started focusing less on predicting recovery, and more on refining himself. Instead of asking, when will this bounce? He asked, am I acting in alignment with the investor I want to become? That shift was subtle but powerful. Because long-term thinking isn't just about price targets years from now. It's about character. Drawdowns are identity checkpoints. They force a choice. You either shrink to protect comfort, or you expand to handle pressure. He chose expansion. Not recklessly. Not blindly. But consciously. He reviewed his risk. Made sure he wasn't overexposed. Confirmed his position still made sense structurally. And once those boxes were checked, he stopped negotiating with fear. Staying still became a decision, not a default. And with that decision came something unexpected. Calm. Not because the market was stable. But because he was. The crash was still unfolding. But he was no longer reacting to every tremor. He was becoming the kind of investor who could withstand them. 7. The quiet edge of stillness. The market didn't ring a bell when it stopped falling. There wasn't some big headline saying, all right, it's over. No dramatic moment. No fireworks. It just slowed down. The drops weren't as sharp. The panic on social feeds felt quieter. The chart started forming higher lows, nothing obvious, nothing loud. You could almost miss it if you weren't paying attention. And the strange part? He didn't feel excited. He felt steady. That was new. Before, relief would have rushed in. He would have thought, I made it. I survived. But this time, it wasn't about survival. It felt more like alignment. Because during the crash, something more important than price had stabilized, his behavior. He started to understand something most traders miss. The real edge isn't calling the bottom. It's not catching the perfect reversal. It's not being the smartest person in the room. It's emotional consistency. People think the edge in markets is better information. Or a sharper strategy. Or faster execution. But crashes expose the truth. The real edge is composure. When prices were falling, he stayed inside his plan. When fear got loud, he slowed down instead of reacting faster. When doubt showed up, he questioned the doubt, not the system he built. And the biggest shift? He stopped trying to remove uncertainty. He accepted it. That acceptance created space. Space between a red candle and a reaction. Space between a headline and a decision. Space between fear and action. And in that space, discipline lived. Stillness isn't passive. It's controlled restraint. It's reviewing your thesis when emotions rise. It's checking your exposure instead of checking social media. It's reminding yourself that cycles are normal, even when they don't feel normal. The crash didn't make him fearless. It made him grounded. There will be another correction. Another wave of scary headlines. Another moment when portfolios bleed and group chats panic. But now he knows something he didn't know before. The market can move violently. Without forcing you to move with it. That realization changes everything. Because long-term thinking isn't pretending downturns don't exist. It's understanding that volatility is the price of growth. Most people try to avoid paying that price. Very few learn to sit through it. In the middle of the chaos, he discovered something powerful. Staying still wasn't weakness. It wasn't denial. It wasn't stubbornness. It was strength under control. And when the chart slowly turned green again, he didn't feel lucky. He felt ready. Not because he predicted the future, but because he learned how to control his response to it. If you made it this far, you already understand something most people in the market never will. Crashes are loud. But growth is quiet. The biggest shift doesn't happen on the chart. It happens inside the investor. We spend so much time trying to learn entries, indicators, patterns, confirmations. But when the market falls, none of that matters if you can't manage yourself. Discipline is invisible. Emotional control doesn't trend. Patience doesn't go viral. But those are the traits that build longevity. Anyone can feel confident when everything is green. Confidence is easy when the tide is rising. The real transformation happens when the screen is red and your mind is noisy, and you choose not to let fear decide for you. That's what this entire journey was about. Not predicting crashes. Not avoiding every drawdown. Not becoming emotionless. But learning how to stay still when your instincts scream to run. Because staying still doesn't mean doing nothing blindly. It means checking your plan. Managing your risk. Zooming out. Separating fear from facts. And deciding from clarity, not panic. Markets will always move in cycles. There will always be another correction, another wave of uncertainty, another moment where doubt feels louder than logic. But now you know this. Stillness is a skill. And like every skill, it strengthens with awareness. If this video gave you clarity, even a small shift in perspective, I want you to do something simple. Comment below, I choose discipline. Not for me. For you. Because writing it down makes it real. If you know someone who struggles during drawdowns, share this with them. Sometimes one idea at the right time can prevent an emotional decision that takes years to recover from. And if you want more content that blends psychology, discipline, and real trading perspective, subscribe and stay connected. This channel isn't about hype. It's about building investors who can last. Like this video so more traders see that calm is possible, even in chaos. And remember, in the middle of the crash, stay still. That's where strength is built.